Welcome into the Artgibbs Sports Business Podcast. Thank you so much for joining us today. And here we're going to talk about why the Denver Broncos, with their recent $4.6 billion purchase price, are worth a $306 million plus tax write-off per year. So why is that? It's because of something called Roster Depreciation Allowance. Now, in a previous episode of this podcast, and I'll include a link to that episode below, we went in depth on Roster Depreciation Allowance, the history, how it came about. For this episode, I'm going to pick it up in 1970. So in 1970, former MLB Commissioner Bud Selig purchased the Seattle Pilots for $10.8 million. In this purchase, he, in an effort to maximize what was allowed to be depreciated, he allocated 94% of the purchase price, or $10.2 million, to players' contracts and the rest to other components like plant, equipment, franchise itself, which could not be depreciated at the time. Because of this large allocation in price, and that was upheld in court, and because of that large percentage of the price going to something that was depreciated, the IRS and the Congress jumped into gear. They moved to adjust the maximum amounts that could be allotted to player contracts to be 50% of the purchase price of the team. And that could be depreciated over 5 years. So 50% of the team divided over 5 years, you can do the math there. And that depreciation, of course, is a tax benefit. It basically reduces your taxable income. That stood for a while. Then in 1993, Congress passed Section 197 of the tax law, and this gave all businesses the ability to depreciate 100% of the purchase price of goodwill, going concern value, and other intangible assets, generally over 15 years. But specifically excluded sports franchises at that time, and so the sports franchises worked with that 50% of the value, or 50% of the purchase price depreciated over 5 years until 2004. Now, in 2004, Congress repealed Section 1056. This is a little, I know. Repealed Section 1056 of the tax code, and this allowed sports franchises to be included under this rule, which made it 100% of the franchise purchase price could be depreciated over 15 years. So all that to say, the current setup is that 100% of the purchase price of a sports franchise can be depreciated over 15 years. Now, some of the nuance there is that the taxpayer can select how much they assign to these goodwill and these intangible assets in terms of, allocating the purchase price. So to clean that up, the IRS allows you to just assume that all of that is going to be allocated to the purchase price. So these sports franchises have this large depreciation benefit, which obviously is a tax benefit. So in purchasing a sports franchise, and again, these sports franchises can be leverage purchases. Even the NFL office has some loans available. There might be different bank groups set up. In general, one person has to be purchasing 35% of that franchise, but leverage is allowed to be used there. So in the NFL, generally 35% of the franchise has to be, owned and controlled by one person, but that purchase can be done with some leverage. So in this case, as we heard today, the Broncos sold for $4.6 billion, a record $4.6 billion for any sports franchise, I believe, definitely any North American sports franchise. And so that comes with this tax benefit. So the owners of the franchise, which of course is the Walton family, among others, the Walton family of Walmart, among others, will be able to depreciate $306 million, a little over actually, if you divide that $4.6 billion purchase price by 15 years. Now, of course, that's a big tax benefit throughout that time. So these franchises, they can operate profitably. And if they operate profitably, the first $307 million of income is not taxed. If they're not operating profitably, the controlling owner, can use that tax benefit in other areas that they may need it. So if they own a lot of stock and there's a dividend paid on that stock, if the NFL franchise is not operating profitably, some of that benefit can shift over to that other investments that owner may have. All right, that's all the time we have for today. Thank you so much for joining us. We'll see you next time.